This is an analysis from Alpha Business Media. I want you to picture the skyline of Kathmandu right now. Or if you've been to Pokhara recently, visualize that famous stretch along the lakeside.
Even Chitwan National Park.
Exactly, even Chitwan. If you look at the physical landscape, you see one thing just dominating the view: construction.
It's everywhere.
It's the gleam of new glass, the skeleton frames of these five-star towers going up, the dust of ambition settling on everything. It looks like a massive boom. It looks like optimism made out of concrete.
It certainly looks that way from the street level. But if you strip away the scaffolding and you look at the spreadsheets, if you really dig into the underlying data, that gleam starts to look a lot more like a glare.
The blinding one.
The blinding one, yeah. Because while the physical landscape is screaming growth, the financial landscape is whispering something very, very different.
And that is exactly what we are unpacking in this deep dive. We're looking at a stack of research that suggests the Nepal hotel sector is heading toward a massive collision. And this isn't some vague future worry where we say, oh, at some point. We have a specific date.
2026.
2026. That is the year the analysis pinpoints as the moment of impact. It's being called a quiet oversupply right now, but the sources say it's about to become a loud financial reckoning.
And the fascinating or perhaps terrifying thing here is that this isn't the tourism crisis in the traditional sense. It's not that tourists aren't coming.
Right, people are traveling.
People are traveling. It's a balance sheet crisis. It's a math problem.
Right, so the mission for this deep dive is clear. We need to figure out why this is happening. I mean, how we got into a situation where we have too many rooms and not enough of the right kind of guests.
Right.
But more importantly, we need to look at the survival guide, because the research highlights two very specific strategies: RevPAR discipline and green energy economics, that are going to separate the hotels that go bust from the ones that actually make money.
Exactly. It comes down to understanding the difference between building a hotel and running a business. And those two levers we're going to discuss. They aren't just industry buzzwords in this context. They are the difference between solvency and, well, foreclosure.
Okay, let's start with the why. How did we get here? Because walking around Thamel or Lakeside, it feels like everyone decided to build a luxury hotel at the exact same time. Was there a specific trigger event?
In a way, yes. To understand the crash of 2026, you really have to look back at the optimism of the pre-pandemic years. Do you remember the Visit Nepal 2020 campaign?
Oh, absolutely. The government campaign. You couldn't walk 10 feet without seeing a poster for it.
Yeah.
That was going to be the year that changed everything.
It was everywhere. And while the campaign itself was, obviously interrupted by the pandemic, it was incredibly effective at one specific thing: signaling to developers that the floodgates were opening. There was this pervasive belief in a perpetual upward curve. Access to credit was relatively easy, banks were feeling bullish, and developers saw the tourism numbers climbing. They made a calculation that growth would be exponential.
It was a classic gold rush mentality.
Precisely. But then the world stopped.
Right, COVID hit.
The world stopped, but the construction contracts didn't. You see, the pandemic paused the opening of these hotels, but it didn't cancel the projects. Concrete was still being poured.
Yeah.
So what you have now is a supply shock.
So all those projects from 2018, 2019?
They're all coming online en masse between now and 2026.
So it's a bottleneck effect.
It's a flood.
Right.
And here's the construction boom versus business boom fallacy. Just because you're building assets doesn't mean you are building a viable market. The recovery in tourism is happening, yes, but it is linear. It's slow and steady.
But the supply.
The supply of luxury rooms, however, that is exponential.
But hang on, I see tourists. The airports are busy. Is the disconnect really that severe?
It is, and here's why. It's about the type of tourist versus the type of room. We built five-star towers. We built luxury. But who is actually checking in?
I'm guessing it's not the high-spending demographic those hotels were modeled for.
Precisely. To fill all these new high-end rooms and justify the prices they need to charge to pay back their loans, the data suggests Nepal would need something like 2 to 2.5 million high-value tourists annually.
And where are we actually sitting?
Not even close to that. And the mix is skewed. The current influx is heavily weighted toward regional travelers, folks from India and Bangladesh. Now, let's be clear. These are great tourists.
Of course.
But they often have different spending habits than the high-yield Western or East Asian tourists that these specific business models were built around.
Right. So if you built a hotel, assuming every guest is buying a $15 cocktail and booking a $200 spa treatment, but your actual guest is just looking for a clean room and a good breakfast, your math falls apart.
your math completely falls apart. They might drive over the border, stay for shorter periods, or just have different budget constraints.
So you have a situation in, say, Pokhara. You've got 10 shiny new luxury hotels all next to each other in Lakeside. They all offer pretty much the same thing: a nice bed, a view, a buffet.
Hmm. Undifferentiated luxury.
But there aren't enough high-spending guests to go around.
When you have 10 identical options and not enough demand, you lose pricing power. And when you lose pricing power, what is the only lever you have left to pull?
You drop the price. You have to start competing on cost.
You drop the price, it's the race to the bottom.
Yeah.
Hotel A drops their rate to fill rooms. Hotel B panics and matches it. Hotel C goes even lower. Suddenly, you have 5-star properties charging 3-star rates just to get cash in the door.
And that leads us directly to the trap, because I think most people, and honestly probably a lot of hotel owners, think, well, if I lower the price, at least I'll fill the hotel.
And a full hotel is a successful hotel. And that is the most dangerous assumption in the hospitality industry right now. That is the 100% occupancy trap. In this specific market, the 2026 oversupply market-chasing occupancy is actually a path to insolvency.
Okay, I need you to really unpack this, because that feels entirely counterintuitive. If my rooms are full, how am I going broke?
Because occupancy ignores the cost of doing business. It ignores the variable costs attached to every single guest. This brings us to the first survival strategy, RevPAR.
RevEA, revenue per available room.
Correct. It's the industry standard for a reason. RevPAR is the only metric that matters because it balances occupancy with the rate you're charging. It tells you the truth about your financial health, whereas occupancy just tells you how busy your lobby is.
The source material has a really great math example here that I want to walk through because it made the light bulb go on for me. It compares two hotels, let's call them Hotel A and Hotel B. Both have 100 rooms.
Right. So let's look at Hotel A. This represents the panicked owner. They see the competition, they get scared, and they just want a busy lobby. So they slash their room rate to 6,000 rupees.
Okay.
Because of that low price, they managed to fill 90% of their rooms.
Okay, so 90 rooms full at 6,000 rupees. That's 540,000 rupees in revenue for the night. On the surface, that sounds decent. You see people everywhere.
It sounds active. It looks successful. But now look at Hotel B. They refuse to play the discount game. They hold their rate at 10,000 rupees.
Okay.
Because they are more expensive, they get fewer guests. They only run at 60% occupancy.
So 60 rooms at 10,000 rupees, that is 600,000 rupees revenue.
Exactly. Hotel B made 60,000 rupees more than Hotel A, despite having 30 fewer guests.
That alone is eye-opening. You're doing less work for more money. But wait, it actually gets worse for Hotel A when you factor in expenses, doesn't it?
Oh, it gets much worse. Think about the operational drag. Hotel A has to service 90 rooms. That's 90 breakfasts to cook. That's laundry for 90 beds and 180 towels. That's electricity and air conditioning for 90 rooms. That's wear and tear on the carpets and furniture for 90 rooms.
Right. Whereas Hotel B is only servicing 60 rooms, their variable costs are significantly lower.
Exactly. So Hotel B has higher revenue and significantly lower operational costs. Their profit margin is healthy. They can take that money and reinvest it, buy better linens, train their staff, market themselves better to the right audience.
Meanwhile, Hotel A is running around like crazy, burning cash on operations, wearing out their building, and actually making less net profit.
That is the death spiral. When Hotel A's carpets get worn out because of all that traffic, they can't afford to replace them because their margins are razor thin, so the hotel starts to look shabby.
Which means they have to lower the price even more.
Even more to attract anyone, and down they go.
It's essentially eating your own asset to stay alive. So the takeaway here for any listener involved in this is resist the temptation to discount.
Hold the line on rate. It is better to have an empty room than a room that costs you money to fill. Survival requires the discipline to focus on RevPAR, not just seeing bodies in the lobby.
Okay, so that's the revenue side. Don't sell yourself cheap. Now let's flip the equation and look at the expense side. Because the source material brings up something I wasn't expecting to be framed this way. It talks about green energy.
Yes. And I know what you're thinking.
Well, usually when we hear green energy in business, it's about corporate social responsibility. It's about having a nice plaque in the lobby that says, we care about the planet.
Right.
But this analysis says, forget the planet. This is a financial weapon.
It's a total reframe, and it's crucial for the Nepal context specifically. You have to look at the reality of the infrastructure here. The national grid is improving, absolutely, but it still has reliability issues, especially during peak seasons or the dry season.
Okay.
And what happens when the power goes out in a five-star hotel?
You can't just let the guests sit in the dark. The generators kick in.
The massive diesel generators roar to life. And diesel is expensive. It is imported, the price is volatile, and it burns fast.
So the argument here is that relying on diesel isn't just bad for the air, it's a massive strategic weakness on the balance sheet.
It's a huge vulnerability. Let's go back to our two hotels. Imagine they are next door to each other in Pokhara again. Hotel Conventional is relying on the grid and diesel backups. Hotel Solar has invested in a massive photovoltaic system, battery storage, and solar water heaters.
But isn't that investment huge? Solar isn't cheap to install.
The upfront cost, the capex is higher, yes, but look at the opex, the operational expenditure. A power cut hits. Hotel Conventional starts burning cash immediately, literally burning it in the form of diesel to keep the lights and the AC on. Their operational cost per hour skyrockets.
And Hotel Solar?
Hotel Solar just switches to battery power. The sun filled those batteries for free during the day. Their cost to keep the lights on is effectively zero in that moment.
The source mentions some pretty staggering numbers regarding the savings. It says a proper system can eliminate 70 to 80% of diesel expenditure.
And that changes the return on investment drastically. We used to think of solar as having, say, a 10-year payback period. But when you factor in the avoided cost of imported diesel in Nepal, that ROI drops to 4 to 6 years.
That's incredibly fast for infrastructure.
It is. And here is the strategic moat, as the analysis calls it. After 5 years, when that system is paid off, Hotel Solar basically has free energy for a huge chunk of its operations.
So go back to the price war. If Hotel Solar has free energy, they can technically afford to lower their rates without destroying their profit margin, unlike Hotel Conventional.
Exactly. Or they can keep their rates high and just pocket the extra margin. Either way, they have a financial advantage that Hotel Conventional cannot compete with. Hotel Conventional is at the mercy of global oil prices. Hotel Solar has inoculated itself against that risk.
So it's not about being green for the brochure. It's about stripping out the second biggest cost after labor so you can survive a market downturn.
It is brutally economic. In a market of thinning margins, efficiency is the only way to breathe. If you aren't controlling your energy costs in 2026, you are bleeding out.
So we've got the timeline 2026. We've got the trap oversupply and price wars, and we've got the weapons RevPAR, discipline, and green energy efficiency. Now let's look at how this actually plays out. The analysis lays out 3 scenarios for the future.
Yes, and these won't happen in isolation. They will likely all happen simultaneously across the market.
Scenario 1 is the scary one. They call it the Great Financial Squeeze.
This is the inevitable correction. You have hotels that are over-leveraged, too much debt, and they don't have the operational discipline we just talked about. They will engage in that suicidal price war.
They'll run out of cash.
They will run out of cash. And then foreclosure. The banks step in. And the source makes an interesting point here. Banks do not want to be hoteliers. They hate being landlords of commercial properties they can't run.
So we're going to see distressed assets.
A lot of them. We will see properties being sold for pennies on the dollar, which, for a savvy investor with cash, is actually a massive opportunity. But for the original developers, it's a total wipeout.
That leads to scenario 2, the rise of the professional operator. This one feels like a maturity moment for the industry.
It is. Right now, a lot of hotels in Nepal are run by the owners, people who are brilliant real estate developers or successful in other businesses, but they aren't hoteliers. They don't know the science of RevPAR.
It's the classic founder's dilemma. I built it, so I should run it.
Exactly. But as the crisis hits, they will realize they can't steer the ship through the storm. They'll have to swallow their pride and hire third-party management firms, international brands, or sharp local management companies.
And these professionals come in with a mandate.
Fix the balance sheet. They will be the ones implementing the dynamic pricing, the cost-cutting, the energy upgrades. It separates ownership from operation.
Which is how it works in most mature markets anyway.
Correct. Nepal is just being forced to grow up very, very quickly because of this crisis.
And then we have scenario 3, my personal favorite, niche supremacy.
This is the smart exit. These are the hotels that look at the price war in Kathmandu or Pokhara and say, I'm not playing.
They exit the commodity market completely.
They decide they aren't selling a room, they are selling an experience that you can't get anywhere else.
The source gives some cool examples here, like a carbon-neutral jungle lodge in Chitwan that focuses exclusively on high-end wildlife photography.
Right, not just a safari. but a specialized photography expedition. Or a wellness retreat that isn't just a hotel with a massage table, but a destination for health recovery.
Or an adventure hub.
Or an adventure hub in Pokhara, specifically for ultramarathon runners or paragliders.
By hyper-focusing on a niche, they make price irrelevant.
Exactly. If you are the only place offering that specific world-class experience, you could charge what you want. You are no longer competing with the 10 identical hotels down the street. You're competing on value, not volume.
You're defending your value through uniqueness rather than discounting.
Precisely. But that requires a level of creativity and bravery that many developers lack. It's easier to build a generic box. It's harder to build a brand.
So as we wrap this up, it feels like the message is pretty stark. The build it and they will come era is officially dead.
It is. The crisis of 2026 is a correction. The market mistook building for business. They thought the asset itself was the victory. But the victory is in the operation.
And for our listeners, whether you're an investor, a hotel owner, or just someone watching the economy, this matters because it's going to reshape the landscape. The names on the buildings might change. The strategies will definitely change.
The question isn't if consolidation is coming. The math says it is. The question is which side of the ledger you will be on. Will you be the distressed asset being sold off by the bank, or will you be the ruthless, efficient operator picking up the pieces?
And I want to leave you with this final thought to mull over. We often associate luxury and hospitality with marble floors, gold chandeliers, and infinity pools. But in a market of abundance where there are too many marble floors and too many infinity pools, maybe the ultimate luxury is actually discipline.
The discipline to say no to occupancy, the discipline to invest in efficiency when everyone else is cutting corners.
Ask yourself, is your greatest asset your building, or is it your balance sheet?
In 2026, we're going to find out.
That's it for this deep dive. Thanks for listening.